Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on July 11th. Ian Saunders, joined here by Miles Clark. Miles, welcome to the second half of the year.
I know. Did you have
Happy
a,
second half.
yes, sir. Did you have a nice 4th of July? It's been a bit.
It was good. Yeah, it was good. It was a nice nice break. Got up to the mountains up in New York, which was a lot longer drive than I was expecting going up there.
Probably on the 4th of July, you were sitting in traffic for a bit, huh?
I went up a couple of days before, but I took I took a different route. I hate the northern stretch of 95, so I went down up 81, went through the mountains, which was really nice, but it ended up being a 9.5 hour drive up. So
Right.
that
Not
was
that nice. And
that was long. Yeah.
mountains, you had a good
But
view.
once we were up there, it was good. Came back to what felt like a sauna here in Richmond. But what about you?
Nothing. Just hung out with a couple buddies and the ladies around Richmond for a bit.
Nice.
Went out and had
Get some
a
fireworks off.
something like that. Yeah, we had pool day, hot dogs, all the full nine
Yeah.
yards, all that type
Yeah.
of stuff. So it was fun.
Nice. Nice. Yeah, I mean, markets over the past week or two have been haven't seen a ton of action. We had a lot of action, especially in our RS rankings, like right to close the quarter.
Right.
And then feel like maybe some rebalance stuff, maybe people going to the beach,
Yeah.
hanging out at the pool, eating hot dogs.
Right.
Things have been a little bit slower, but we still seen some action over the course of the past week, right?
Yeah, over the course of the past week, again, mostly positive there. S&P 500 up around 60 bips or so, continuing higher. We'll take a look at that chart in just a moment. Other names of note, crude oil there, so some energy focused areas leading the way higher. Russell
How much
2000,
was crude up?
about 1.5%.
Oh wow, okay,
Yeah, so not bad.
yeah. There's a
Um,
lot of people driving around for the
yeah,
fourth thing.
something like that. Russell 2000, Nasdaq Composite, so other areas that kind of the domestic equity space towards the downside. Gold continuing its recent consolidation there. TLT, so some longer duration bonds, and emerging markets pretty much flat for the last week.
So
So
muted, slightly positive on the risk side for most of the stuff across the board.
yeah, I'd say that's pretty fair.
I mean, we saw it kind of sounds similar to maybe not muted, but when we're looking at performance for the first half. Now that we finished the first half, the first podcast we've had in the second half of the year, we do some tables every quarter that kind of is like a checkpoint to see what were the performance leaders for the quarter and for the year, and what are the performance laggards, right? And I think those are pretty helpful to provide some perspective because we talk a lot on this podcast every week about what five charts we're looking at this week,
Right.
right? When you take a step back and look, okay, where have things sat so far on a year-to-date basis? There's some surprising stuff in there. So we'll take a look. We'll still have five things to look at today. Two of those things are going to be three charts. So sorry, they're going to be three. There are three or four charts kind of stacked up. But we're going to look at year-to-date performance for kind of all ETFs and the domestic equity focused ones, and then a separate picture of year-to-date performance across the other various asset class slices.
Yeah, I don't
Um,
want to hear any complaints down in the comment section because you're essentially getting what is it, 12 charts or whatever it is for free. You're
we
getting
could
but
get more. I mean, that's we cut off half of the charts in that article that was released on Monday too. So we'll focus on the ones on a year-to-date perspective, and then we'll hit on for the remainder of the podcast a few of the individual charts that also are on here, but also kind of show up and saw some pretty interesting movement recently. But when we're looking at so the first section, looking at go ahead and throw the chart up on the screen. We'll look at the all ETF performance, top 10, bottom 10, broad domestic equity, and then sector on the domestic equity side. A lot of consistency across the top end of many of those charts. You had on the all ETF, I think it was pretty interesting to see pretty diverse representation at the top end of the all ETF year to date performance stuff. I mean, you had some international stuff in there. You had the defensive tech. You had gold miners. I mean, it was pretty broad in there,
are
which
those ARC funds? Sorry, I knew
no, go ahead, keep
are
going.
those ARC funds just domestic or they go international too? Because if they are international, I know they're going to have domestic stuff in
Are
there.
you looking at the second quarter one?
Oh, darn it, am I looking at the wrong one?
Well, so yeah, we
Yeah.
can. I mean, so we did see Kathy Wood make a comeback. She had three of her funds in the top 10 performing areas over the last 3 months, right? In the second quarter, but not quite in the year to date stuff.
Well, that's not it. It even furthers my point. No, because where I was going with the ARC stuff was, well, I wasn't seeing anything purely domestic there leading the way. That is just confirmed when you look at the annual performance. There's nothing that is purely domestic equity side of things that is in the top 10 in this case.
Yeah, Yeah, I mean that's
Interesting. I wonder when the last time that was.
I I don't know. We'll
Yeah.
definitely we know some people that can go check. But yeah, that's a good point. I think it speaks to you look at the all ETF stuff. I mean, you're seeing like Global X Defense Tech up
Yep.
61% year to date. Junior gold miners up 58% year to date, right? Some massive numbers up there. When you talk about the S&P that's up like 6%
Yep.
on a year to date basis, it doesn't come close. European Financials is the 10th best performing fund, and it's up 39%, was up 39% year to date, right? I mean, there's just a very wide margin between that and the S&P just beneath it. But I do think it speaks to the breadth of improvement we've seen across the markets. I mean, we saw a lot of jockeying for position in the top end of the Dolly rankings with domestic equities leading and then international and then commodities, then international, then back to domestic equities, right? And you see that reflected here. That's because there are a lot of other areas that are doing well. It's not that the domestic equities have been doing poorly.
Right.
There's just a lot of strength in other areas of the market.
Yes, good point. I mean, you look over, we can kind of tiptoe over to the domestic equity side of things. Nice to see as a trend following shop momentum doing pretty well.
Mm.
Large cap growth, right? You get even some value in there. Mid cap growth. Really, for the most part, it's a lot of growth up there, which again is
Actively managed dividend value. I think that's important to note though,
yeah,
on the capital group side there with that capital group dividend value ETF, because a lot of the other value related stuff that more index related, those were in the
right.
worst 10 funds. But the active management, I mean, we've seen the explosion in the actively managed ETFs over the course of the past couple of years, and some of those funds, I mean, actively managed pretty well, right?
Yeah, no, you'd certainly say. I mean, again, you're looking at just trends, and we will talk about it actually in our upcoming webinar. Which shout out the plug for the Weight of the Evidence webinar next
Yeah.
week. But you've seen a lot of these trends, at least on the domestic side of things, really rebound nicely over the course of the second quarter after declining in April. And really, beginning of the year was spurred higher by growth focused names. Of course, 2024 spurred higher by growth focused names. We're really seeing that continue as we open up the second half of this year with, momentum continuing to do well, large cap areas, the core of the market doing relatively well. And then just like you said, Ian, on the opposite side of that, you're getting dividend focused areas, more of your indexed value type of deal,
Small caps.
small cap
Small caps
continuing to do
really
well.
continuing to lag.
Or yeah, lag, excuse me.
Right. I mean, that's been a consistent area of weakness and shown some brief stints that, maybe it'll come off the bottom, right? But it certainly is looking to continue that at least over the past 6 months.
Yeah.
And looking at the sector side of things, that's when you get your Cathy Wood coming back in
Right.
there with a couple of those, the Arc Web and then the Arc FinTech Innovation, both up over 30% year to date. Not too shabby, I would say. You get some miners in there up at the top, unsurprisingly. But again, diverse. You get U.S. aerospace and defense right on top of social media. It's just a
Right.
lot of different names that are seen within there. Just speaks to the breadth of improvement that we've seen over the first 6 months. The we're not seeing that breadth as much on the negative side of things, which makes sense. Really focused on healthcare and energy seem to
Right.
kind of be leading the laggards, I guess, to the downside. And then your pure U.S. cannabis ETF down there at the bottom.
It's actually made a resurgence over the last week or so since this table's been updated. So maybe it's not down 36 anymore, but
It was at that point.
who knows? Regardless, that's a whole nother story. But one more thing before we actually look at another chart. We didn't plan on necessarily talking about this. I also want to mention, SPY and RSP relatively close to each other there as well, talking about, areas on the domestic front that are continuing to kind of do
They
well.
were on the year-to-date basis because of the RSP outperformance in the first 3 months. But if you look at it over the Q2
Okay.
numbers, S&P was up over 10%, RSP up just over 5.
Okay.
So you're seeing that, and that I think that speaks to, I mean, we saw it's a V-shaped recovery up,
Right.
right? You just didn't see RSP go down as much, and you didn't see it bounce back as much either. That rubber band didn't stretch as much, and so
Right.
they're closer now, but I think their point to point move was a lot different than that intra half movement, right?
Yeah.
But yeah, definitely something interesting to monitor. I mean, that's if we see the we see breadth improving, that should benefit equal weighted stuff more,
Yes.
right?
Technically.
Technically,
Right. You never know what happens.
you never know. We never know. We're just throwing darts at the wall there.
But probably the most important technical comment as we continue to meander our way through our charts, the S&P 500 there continuing to hit all-time highs over the course of the first week of July or so. S&P 500, we're getting back into that conversation. It really feels like, oh, well, what do we do? We're a bit overbought, right? I mean, like it just feels kind of somewhat relentless in that conversation. Now, sans that big exhale down in April, but again, now we're on that default chart, pair of consecutive buy signals, support just below the middle of the trading band, moving up past, somewhat convincingly, I might add, past those February highs at this point. And again, really only problem with this is that we're up near 90% in terms of our weekly overbought oversold rating. What do we do?
Were you asking me, or is that? I mean,
Well, no, just
yeah, no. I think that's a natural question. I think
yeah,
everyone's asking themselves, right? The market's back at all-time highs. Is it time to lighten up exposure?
right,
Is it? I don't think anyone's thinking, oh, it's time to sell
right.
necessarily at this point, but I think we put a lot of pieces around this. One of the really interesting pieces I thought was looking at the piece Jamie put in the report. We won't put this table up there just for the sake of time, but I'll talk through it quickly. That just shows what investing in the market every year, what your forward returns are, and just a big matrix looking thing. If your forward returns 1 year, 2 year, 3 year, all the way out to 35 years. If it's green, it's good. If it's red, it's bad. There's been very few years where if you just invest every year that you don't end up with green 10, 15 years out, right?
Right.
And I think that speaks to the concept too of we've had pieces in the report in the past. What does the market look like if you only invest at all-time highs? Forward performance isn't that bad on the longer term perspective. It's pretty normal, right? I mean, it's good. Over the net intermediate term, there's certainly been some rough patches there, and I think you could say that more so when you're looking at the overbought oversold thing. Or I think Trevor's talking about that in the report today. If you're investing in the market when it's so overbought, right? Not necessarily at all-time highs, but when its weekly OBOS is pretty high, your near-term performance 1 week, 2 week might be more muted.
Right.
Long-term performance doesn't affect it.
Right. You're still relatively fine.
Right.
I think, the biggest hurdle, and then we can move on to the next chart since I know we're behind on time.
That would good.
The point of it is that so many people will say, okay, well, technical analysis, PNF specifically there, you're going to be so kind of locked in on support and resistance levels, right? Well, at all-time highs, there's no such thing as resistance, right? So it kind of handicaps you a little bit. So using, hey, we near-term indicators of, how overbought are we? That becomes pretty important because you don't have resistance to look towards. It's really just like, hey, when do we pull back a little bit? When does it make logical sense to pull back? And ultimately, that becomes your next point of resistance, so on and so forth. So again, being all at all-time highs is not a bad thing. It just, be a little more cautious, I guess is the question in the near term.
Yeah, and I think there is support that you can look toward on the default chart there, right below the midpoint on a trading band, down there around the 5,800 mark.
Yep.
I would expect some, even though we don't look at it on the classical point figure perspective, those prior all-time highs of around 6,100 would probably be some support as well. If we got a reversal lower, and coincidentally, that would be a three-box reversal,
Correct.
would put us right at that level. I would expect that to probably be some natural support that could come into play too if we did get a pullback.
Yep.
But overbought can very quickly become more overbought. And the
Yes.
trading band can normalize either through a pullback or just by staying at its current point, right?
Good point.
I think that's definitely some interesting places to monitor there. But yeah, the S&P has certainly shown some consistency over the past few weeks, but other areas of the market have shown a little bit more consistency. And if we go back to the top 10, bottom 10 tables on the other asset class perspective, looking at international equities, commodities specifically, a lot of consistency there over the past several months.
Yes. You look at, commodities specifically, gold, talk about consistent, has cooled off a little bit, but it's still a relative strength leader there. Precious metals, just in general, right? You look at that, platinum group in terms of its year-to-date performance, excuse me, platinum, gold, another precious metals, right? And then copper right there, kind of as an industrial metal, as a point of strength, kind of rounding out the top five in terms of its yearly performance. But yeah, in terms of kind of relative strength, precious metals have really been the name of the game.
Yeah. And when you're looking on the international front, Europe has been the name of the game by and large across the board. You have the Europe aerospace and defense up solidly over the past 6 months. Poland, Greece, Austria, Spain, European dividend, European financial. I mean, it's like almost all the top 10 was all Europe. And we've seen that hasn't been a new theme. That's been pretty consistent over the past 4 to 5 months at this point, I would say, if not longer, 6 months at this point. And so that consistency, I think, from both of those areas is will definitely be important to look at from the international asset class as a whole, as well as from individual commodity areas. Whereas maybe commodities is back down to third and dolly, but there's certainly some areas like you mentioned copper that are looking pretty good.
Well, yeah, and you mentioned it's third in Dolly as in our kind of broader rankings, but going back to the very start of the podcast where we talked about just broadly speaking, you're getting areas across the board. These guys are still ranking within just a couple signals of each
That
other.
could change
So
one day.
exactly. Speaking of what could spur some of that signal change has been recent developments out of copper. Over the last week, we did see copper put in actually one of its best days ever, if not the best day ever, going back to 1989, spurred on by some of the kind of the tariff comments from President Trump.
Yeah, you put a pretty interesting chart in the report on the daily price distribution. Well, we can throw it up on the page, but maybe just for those that are listening, what is that chart looking at?
Yeah, it was just a simple daily distribution of returns for HG backslash, which is the continuous copper contract that we track on the platform there. It was the 99.99 or whatever it is, the best or the second best day for copper. It was up around 13% through action. I believe it was Tuesday into Wednesday or Monday into Tuesday, whatever it was. But yeah, one of the best days ever.
So, I mean, tariffs have caused a lot of prices to go down. They caused copper to go up, right?
Exactly in that case. And you look at it, copper and industrial metals in general have been a point of relative weakness, at least comparatively
Right.
to precious metals. Now, that's been a point that hasn't been contributing to commodities strength. If kind of spurred or as a catalyst through tariffs, if copper can start to pick up some signals, that could be a well of signals that hasn't been tapped yet.
Yeah,
I'm
and
not saying words,
I
but
think it's kind of interesting because you look, I mean, obviously that one 13% day is a massive column of X's on that chart, but you saw a lot of consistent movement on copper really from May. I mean, it was really semiconductor started to pick up. You saw copper start to improve, which makes some sense given the copper is needed in a lot of the semiconductor manufacturing, right?
right.
And at Dr. Copper is the kind of classic term for it, right? Copper moving higher is a bullish sign for the global economy, typically, right?
Yes.
Because it's more the industrial metal. It's used in the application of
More
building
volt.
out a
Yeah.
lot of these technologies, right? That's another interesting point to kind of consider as we look toward the second half of the year. Yeah, copper had a massive day because of a social media post or
Right.
of tariff announcement. But it had shown consistency prior to that move.
Yes. No, that's fair. And I mean, you're overbought right now, extremely overbought. So you could see some normalization. You look at the chart of CPER, just a proxy, coming back down to the top of the trading band around $33 or so. That's a logical point of a possible support going forward. And again, I think the biggest takeaway is how much does that contribute to commodities? If you do see further consistency, how much does that contribute to commodities by ranking or rankings ultimately going forward in the back half of the year?
Yeah, and it could even be, it might not, maybe it won't add a lot more because a 13% day is probably going to cause most things to go to buy
Right.
signal, but it might make it hold up longer
Correct.
too.
That's fair.
I mean, there could be some pretty interesting dynamics to consider as we look toward. If you see that hold up longer and then all of a sudden oil starts to be more consistent, that things could get interesting.
Right. And they
Um,
certainly could.
and another area, the last chart we'll hit on for the day, was back on the global and international space. Joseph put an interesting piece in the report yesterday, right?
Yesterday.
So we're recording this on Thursday. It was in the report on Wednesday. Obviously, you all are listening at Friday at the earliest. But we're seeing the score direction history for global and international funds. So we have fund score for global and international. No, we have fund score for everything. 0 to 6. 0 is the worst. 6 is the best. One of the indicators that we track for fund classifications. So we take all the global and international funds together. That has a score, right? And then we also have a score direction. What is that? Where is that score moved from a peak or a trough over the last 6 months? Which basically just means how has it gotten to this point,
Right.
right? And it's gotten to that point pretty quickly, at least for historical standards.
Right. Yeah. I mean, so the score can range, it can be positive or negative, right? So you think about a regular fund score, 0 is the bottom, it can go. But in this case, we can have positive or negative score directions indicating scores moving up we're moving down. In this case here, you look at that all global and international diversified chart that we're throwing on the screen, there's a score direction of near 2. Now, point being is that has, if you look back at data since 2004, we've gotten to that point, let's just say 1, 2, 3, 4, pretty much 5, maybe 6 in
This is
there.
the sixth time. Yeah.
This is the 6th time. That's been a pretty significant point where we've backed off. Now, the question is, what does that back off look like? Is it backing off and staying there, or is it backing off because there's weakness emerging? And this chart doesn't necessarily tell you that. That's just going to be you got to look at each one of those specific instances. Does that
Yeah,
right?
I think it is tough. So it's good to it's good to see the score improving, but it's tough because the time period we're looking at, we're talking about all of those 6 instances are occurring from 2009 to present.
Right.
How have international equities done from 2009 to present? Not that
Yeah,
great, right?
Washington.
If you look back right before that, so we have a pretty limited period, 5 years from 2004 to 2009. You got a brief stretch in there from 2006 to 2008 where you had positive score directions that kind of backed off into negative score directions, but the score hung up there, right? And so even though we didn't see as sharp of a move back then, probably because the score was already higher, it would have been higher if we had brought scores back further. Just because the score direction moves lower doesn't necessarily mean that the score itself has to be moving a
That's
lot
the
lower.
point I was trying to make. Thank you for clarifying. Yeah. But yeah.
Yeah, and that's like I think an important point to note and to think about because the score direction over the past 6 months, so the longer we get out from that, that number will naturally kind of tick up, but the score hangs around. Um, but at the end of the day, I mean, you still see international equities performing well, scoring well. They're pretty close in the Dolly rankings as well.
That rhymed. Or we just said the
I
same
just said
words,
the
I
same
think.
word. I don't know if that counts as rhyming,
Jesus.
but hey, I'll take that. Um, yeah, I think it's those score dynamics are definitely interesting to look at. You definitely want to be cognizant of what the actual data is telling you that.
Yeah, certainly. And what the data has told us so far in 2025 is international equities have done well.
Yeah.
And so, I mean, there's probably some studies that we could do about, hey, when international equities outperform in the first half of the year, what happens in the back half of the year? I don't have that answer right now, but that's going to be something to watch as, the dollar continues to decline. That's going to be a tailwind for international equities. Of course, there's geopolitical stuff going on. There's tariff implementation that could be coming as soon as August 1st, right? So there's plenty of news that could emerge over the next couple of weeks that could make for a pretty busy a back half of 2025.
Yeah. Sounds like we got at least one of our charts for next week already.
I think so.
Yeah, anything else for us to hit on?
No, appreciate everyone's time as always, spending your Friday afternoon with us or whatever it is, and we'll be back again next week. Appreciate y'all.